Imagine having the power to predict stock market movements with near-perfect accuracy, using nothing but the latest algorithms and artificial intelligence. It's the ultimate dream for any investor, right? Welcome to the AI-driven world of financial predictions, where advanced technology is changing the way we think about wealth creation. But before you jump in, there are questions we all need to ask. How reliable are these predictions? What are the risks? And can you really trust an algorithm with your money? Artificial intelligence is shaking up the financial world in ways we couldn't have imagined a decade ago. AI-driven investment models analyze enormous data sets in seconds, revealing patterns that humans simply can't see. These models don't just look at market data, they're analyzing economic trends, global events, and even social media posts to forecast stock movements. Hedge funds and financial firms have been at the forefront of this movement, claiming impressive returns by using these powerful algorithms. But just because AI can process vast amounts of information quickly, does that automatically make it the right choice for every investor? Let's break this down by looking at what AI-driven predictions actually do. AI models learn from historical data. They study past stock market movements, financial indicators, and even the tone of news headlines to make future predictions. When new information comes in, let's say a big tech company just announced a new product, these algorithms adjust, weighing the potential impact on the stock price. But the catch is that AI, like all technology, is limited by the quality of the data it's trained on. If it's never seen an event, like a sudden economic crisis, its predictions might not be as accurate. And that's something every investor needs to consider. Take the COVID-19 pandemic as a prime example. When global markets crashed in early 2020, many AI-driven models struggled. They'd never been trained on such a massive and sudden event. While some algorithms adapted quickly, others failed to predict the extent of the impact, leading to substantial losses. This was a wake-up call, not just for tech-driven funds, but for the entire financial world. It showed that AI, while powerful, isn't invincible. It also made one thing clear. In unpredictable times, human judgment and flexibility are still essential. Speaking of unpredictable events, let's talk about global politics. Political events, like sudden policy changes, international trade shifts, or surprise election results, are some of the hardest things for AI to factor into market prediction. For instance, AI might analyze a trade agreement between two countries and predict a positive outcome for certain industries. But if that agreement falls apart overnight, the algorithm is left scrambling to adjust. And the reality is that these political variables are harder to predict, no matter how advanced AI becomes. Investors who rely solely on algorithms could find themselves unprepared for sudden shifts. This brings us to the question of who's using these AI-driven tools. In the high-stakes world of finance, hedge funds and institutional investors are all over this technology. They have access to custom-built AI models trained on unique, proprietary datasets that average investors simply can't access. These firms spend millions developing systems that give them an edge over others. For individual investors, however, the story is different. The tools available to them are often more generic, relying on widely available data that lacks the nuance of proprietary models. While AI tools marketed to everyday investors might sound promising, they're not the same as the highly specialized ones used by the big players. But let's not forget about social sentiment analysis, something that's exploded in the age of social media. Imagine an AI model that can analyze the sentiment of tweets, Reddit posts, and financial news, predicting how public opinion might affect a stock's price. It sounds futuristic, but it's happening now. Just think back to the GameStop saga. Retail investors gathered on social media, rallying together to drive up GameStop's stock price, creating chaos in the markets. Some AI algorithms actually caught wind of this early by monitoring social sentiment. It was a reminder that markets aren't just driven by economics, they're shaped by human behavior. And while AI can spot trends, predicting the human psyche is a whole other challenge. Another critical area where AI is making waves is ESG, environmental, social, and governance investing. More investors are interested in companies that prioritize sustainability and social responsibility. AI helps in this by analyzing companies' sustainability reports, media coverage, and even satellite imagery to assess their environmental impact. But here's the twist. Many of these metrics are qualitative and hard to measure. For example, a company might claim to be eco-friendly, but if their environmental practices aren't thoroughly scrutinized, the AI's prediction might not reflect the reality. For investors focused on ethical investing, relying on AI can be tricky, as it doesn't always capture the nuances behind corporate behavior. Now let's get into the nitty-gritty. AI's impact on day trading. For years, day traders relied on charts, graphs, and their gut instinct to make split-second decisions. But with the rise of AI, that's changing. AI-powered trading platforms use data-driven predictions to identify trends and advise traders on when to buy or sell. It's fast, efficient, and in many cases, accurate. But day trading isn't all about speed. It's also about risk management, and that's where things get complicated. AI may tell you to buy a stock, but if the market shifts suddenly, it's up to the trader to react. Relying entirely on an algorithm in such a fast-paced environment could be a risky game, especially for those who don't fully understand the technology behind the predictions. So, what's the takeaway? Is AI the future of investing, or is it just another tool in an investor's arsenal? The truth is, it's both. AI is a powerful technology that has opened doors to insights we could only dream of in the past. But it's not magic, and it's certainly not foolproof. Even with the best AI-driven predictions, investors must remain vigilant, understand the technology's limitations, and never abandon their own judgment. Before we wrap up, let's take a moment to think about the ethical questions surrounding AI in finance. With great power comes great responsibility, and that's especially true here. Financial markets impact people's lives directly. When big players use AI to manipulate or predict market trends, there are potential risks for smaller investors who don't have access to the same tools. The AI advantage might lead to an imbalance, creating a market that's less accessible to average investors. It raises the question, should there be more regulations around AI in finance to ensure fairness? At the end of the day, artificial intelligence is reshaping how we approach investing. It's creating new opportunities, revealing hidden trends, and giving investors an edge. But as we've seen, it's not a silver bullet. It's a complex tool that requires knowledge, caution, and a critical eye. For anyone interested in using AI to invest, the best approach is to stay informed, understand its limitations, and combine it with human intuition and strategic thinking. If you found this exploration into the world of AI-driven financial predictions insightful, consider subscribing to our channel for more in-depth analyses on the intersection of technology and finance. Don't forget to hit the notification bell to stay updated on our latest content. And if you have thoughts or questions, feel free to drop a comment below. Let's talk about the future of investing.